$750. That's what Donald Trump reportedly paid in federal income tax in 2016, and again in 2017. Jeff Bezos, zero. Twice, in 2007 and 2011. Carl Icahn, the billionaire investor worth over $15 billion, also reportedly paid as little as $750 in some years. Meanwhile, the average American teacher pays around $8,400 a year. This isn't a conspiracy theory. This isn't tax evasion. This was confirmed by ProPublica's leaked IRS files in June 2021 and by the New York Times in their bombshell Trump tax investigation. It is all completely, perfectly legal. Here's what makes this insane. The average American household pays about 14% in federal income tax. Teachers, around 18%. Doctors, often more than 30%. But according to ProPublica's analysis, between 2014 and 2018, America's top 25 wealthiest people paid a true tax rate of just 3.4%. Some years, 0%. Now here's the part nobody tells you. What they're doing is not hidden. It's not buried in some Swiss bank vault. It's written right inside the US tax code, sitting there in plain sight, waiting for anyone who knows how to read it. By the end of this video, you'll know the 4 strategies the wealthy use, the ones the middle class was never taught to look for. Strategy 1 has a name straight out of a thriller novel: buy, borrow, die. Strategy 2 is why Elon Musk takes a $1 salary. Strategy 3 is how Trump paid less tax than your Uber driver. Strategy 4 turns charity into a wealth shield. And the last 60 seconds? The one mindset shift that separates the people who pay taxes from the people who legally don't. Let's open the first door. Buy, borrow, die. It sounds like something from a crime novel, but this strategy has a real academic name, coined by USC law professor Edward McCaffrey, and it is the single most powerful wealth protection move ever discovered. Step 1. Buy. Here's a secret no school teaches. The IRS has very specific definitions of what counts as income. If you get a paycheck, that's income. Taxed. If you sell a stock for profit, that's income. Taxed. But if you simply own something that grows in value, stocks, real estate, a business, the IRS sees that as zero income. When Elon Musk's Tesla stock exploded from worthless to over $200 billion, his official income for tax purposes barely moved. Because gains on assets you haven't sold aren't taxed. They're called unrealized gains, and they are invisible to the IRS. Step 2. Borrow. But wait, billionaires still need cash to live, right? Mansions, yachts, private jets, that very expensive haircut Bezos has now. Here's where the magic happens. They don't sell their stock. Selling would trigger capital gains tax. Instead, they walk into a bank or call their private wealth manager and say, I own $10 billion in Amazon stock. Lend me $100 million against it. The bank says, done. Why? Because to a bank, a billionaire's stock is the safest collateral on earth. And here's the part that breaks people's brains. Loans are not income. You don't pay tax when you borrow money. You never have. Bezos, Zuckerberg, Larry Ellison. They reportedly use lines of credit backed by their stock, sometimes called stock-based loans, to fund their entire lifestyle. They live like kings on borrowed money, while their wealth keeps multiplying behind the scenes, never taxed. Step 3. Die. This is the dark part and the genius part. When a billionaire dies, their heirs inherit those assets at what's called a stepped-up basis. Translation: the IRS pretends the heirs bought everything fresh at today's price. All the gains from a lifetime, sometimes hundreds of billions of dollars, vanish from the tax books forever. So the strategy completes. Buy assets, never sell, borrow against them, never get taxed, die, wealth passes tax-free to the next generation. Repeat across generations, and you build dynasties. This isn't a loophole someone snuck into the code. This is the US tax system working exactly as written. Now let's talk about why Elon Musk reportedly took a $1 salary at Tesla. Was it humility? A nice PR move? No. It's one of the most brilliant tax moves available in America. The US tax code splits income into 2 main types, and they're taxed wildly differently. Wages from a job? That's W-2 income, federal rate as high as 37%, plus state taxes, plus payroll taxes. But profit from selling stock you've held over a year, that's a long-term capital gain. Federal rate, maximum 20%. That's a 17 percentage point gap for the same dollar. What do billionaire CEOs do? They take almost no salary. They pay themselves in stock. When their stock goes up, they don't pay tax. When they want money, they borrow against the stock. Remember strategy 1. When they finally sell, they pay only 20%, not 37%. Meanwhile, the Tesla factory engineer making $150,000 pays a higher effective rate than the CEO worth $200 billion. Same country, same company, two completely different rule books. The US tax system doesn't punish wealth, it punishes earning a paycheck. Now let's talk about the invisible wealth machine, real estate. According to the New York Times investigation released in September 2020, Donald Trump paid just $750 in federal income tax in 2016 and again in 2017. In 10 of the previous 15 years, he reportedly paid nothing at all. How does a billionaire who owns skyscrapers, golf courses, and hotels pay less tax than a barista? 2 words: depreciation and deductions. Here's the trick the IRS lets real estate investors use. They get to pretend their buildings are slowly falling apart, even when those buildings are gaining value in the real world. If you own a $5 million apartment building, the IRS lets you deduct roughly $180,000 per year as depreciation. Even though your building is going up in value, the IRS treats it like it's decaying, and you get to use that loss to wipe out your other income. That's called a paper loss. It looks like a loss on your taxes, but in reality, you're getting richer. And it gets better. When real estate moguls eventually want to sell a property, they use a tool called a 1031 exchange. Sell one property, immediately reinvest into a similar one, and the IRS lets you defer the entire capital gains tax. Defer it again and again for decades until strategy 1 kicks in. They die. Heirs inherit at stepped-up basis. The decades of deferred tax erased. This is why nearly 90% of American millionaires own real estate. Not because it's the best performing asset, because the US tax code rewards it more than almost anything else on earth. Now for the strategy that sounds most generous and is often the most calculated. When you hear that Mark Zuckerberg pledged 99% of his Facebook shares to charity, or that Bill Gates is giving away his fortune, you probably imagine money flowing to hospitals, schools, the homeless. But there's a hidden architecture underneath. Wealthy Americans rarely donate directly. They donate to structures they control. Private foundations, donor-advised funds, charitable trusts. Here's what happens when they do. 1. They get a massive tax deduction the moment they donate, often before any of the money reaches a real charity. 2. The money sits inside that foundation, growing tax-free for years, sometimes decades. 3. They retain control over how and when that money is given away. 4. Foundation employees often include family members, drawing comfortable salaries from the charitable assets. 5. They earn the public title of philanthropist, a reputation that is itself worth millions in business and political influence. Some giving is absolutely genuine. Real lives have been changed. But the structure itself was designed for one purpose: turning taxable income into a controlled, tax-protected multi-generational asset. They get the deduction now, the control forever, the reputation always. Now you might be thinking, this is fine for billionaires, but what does it mean for me? Here's the truth. You have access to smaller versions of every single one of these strategies. You just have to know they exist. 1. Form an LLC. The moment you legally turn a hobby or side project into a business, you unlock deductions employees can't touch. Home office, internet, equipment, mileage, even business meals. One small LLC can cut thousands off your annual tax bill. 2. Max out tax-advantaged retirement accounts, a 401k, a Roth IRA, an HSA. These are your personal, legal tax shelters designed by the government for normal people. Most Americans either don't use them or don't max them out. 3. Get into real estate, even small. A single rental property unlocks depreciation, mortgage interest deductions, and long-term capital gains advantages. You don't need to be a mogul, you just need to be an owner. 4. Think in assets, not income. Every dollar you earn from a job is maximally taxed. Every dollar you earn from owning something is minimally taxed. The U.S. tax code is a roadmap. It punishes earners. It rewards owners. The wealthy didn't break the system. They simply learned how to read the map. Here's the brutal, beautiful truth. The U.S. tax system was never built to punish the rich. It was built to reward owners and tax workers. The middle class is taught to be the best employee they can become. The wealthy are taught to never become employees at all. You can spend your life angry that the system is rigged, or you can spend your life learning how to read it. The tax code is a roadmap to wealth. The rich follow it. The rest of us ignore it. The information in this video isn't hidden. It's in IRS publications, in tax law textbooks, in ProPublica's leaked files. It's been sitting in plain sight for decades. But the wealthy were taught to read it, and the rest of us were taught to fear it. That gap? That is the real reason the rich keep getting richer. If this video opened your eyes, even a little, hit subscribe. On Calibrated Wisdom, we decode the systems behind money, mindset, and high performance. No hype, no motivation, just the real systems wealthy people use, made visible.